I want to talk for a minute about some principles of asset allocation because we got a lot of asset allocation questions we're going to be dealing with today. So I think let's go over a few principles to start with. Okay. First of all, your taxable accounts should generally be filled with the most tax efficient investments. Okay. Bonds are generally put into tax protected accounts, but it doesn't really matter or may even be reversed in times of lower interest rates. If you are placing bonds in taxable, be sure to compare the after-tax yields to decide if municipal bonds are appropriate for your portfolio. They are for most people in higher tax brackets most of the time. Of course, make sure you're rebalancing only in tax-protected accounts to avoid capital gains taxes. And take advantage of the best, which are usually the lowest cost investments in your employer's retirement plans, and then build the rest of your portfolio around those. Keep in mind the effects of Roth versus tax-deferred placements. When you put assets with an expected higher return preferentially into Roth accounts, that increases the risk of the portfolio on an after-tax basis, and vice versa. It also increases the expected return, of course. It's not a free lunch. Expected return, higher risk, because more of the after-tax assets are actually in the riskier asset. And of course, keep in mind the future growth of the various accounts as you place assets into your various accounts. And it's helpful to have at least one account with more than one asset in it to aid in rebalancing. So generally, you want at least one asset in each account to be found in at least one other of your accounts. If you're trying to rebalance between 401ks and Roth IRAs and taxable accounts and that sort of thing. But the basic process here is to come up with a specific asset allocation plan and then figure out what you have in each of your accounts. How much money you have in your 401k, how much in a Roth IRA, how much in your spouse's 403b and 457, and how much in your taxable account, and to write all that down. Put it in a spreadsheet, put it on a piece of paper, whatever, and then you can decide what goes where. So first you get an asset allocation, then you figure out where your money's at in each type of account, and then you decide how to implement that asset allocation across the various accounts. If you're not sure what asset allocation to use in the first place, I recommend a blog post I did called 150 Portfolios Better Than Yours. It's not just 150 portfolios anymore. I think it's over 200. But each of them is better than a lot of the asset allocations or a lot of the investing plans or portfolios that a lot of people are running around with, which are just nonsensical. So check that out just to get an idea of what a reasonable asset allocation looks like and what things you ought to be thinking about when you look at an asset allocation.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.